Hello everyone. In just 18 weeks of time, the world has more than 1 million people be confirmed with the coronavirus, and more than 50,000 people died from it. It's not only more contagious and more widely spread than the 2003 SARS, which mainly contained in the Asian country and has only about 8,000 people get confirmed. The world economy is frozen because of this coronavirus. We are seeing the crude oil price plummeted. We are seeing the stock price has also crashed. And the world government, US, UK, Australia, Canada, and China, they're all providing unprecedented policy to try to save this economy. And this G20 leadership has already pledged about $5 trillion, and US alone is about $2.1 trillion to save the economy. What we're experiencing now is going to deeply reshape the future's financial and world economy landscape. The $2 trillion CARES Act in the US was pushed out onto the stage in this backdrop. And in this big stage of history, we're going to see a huge magic that's turning $2 trillion into actually $6 trillion. In the previous video, it takes some time to explain why the Federal Reserve has to save this bond market and why the Federal Reserve has to provide liquidity to buy the corporate and even municipal bonds. And even though not many people are very familiar with the bond market, but you probably hear about quantitative easing. The Federal Reserve is flooding the liquidity into the market. So you probably a little bit easier to understand what do we mean by liquidity. And now let's talk about the tools to provide the liquidity, which is the lending facilities by the Federal Reserve, and how this lending facility will be used. Normally speaking, the central bank, they have a basket of, we call that a policy tool set. And in this policy tool set, there are so-called the lending facility. Not only the US, but many other countries are using that. Even though it sounds like a jargon, it's complicated, but it's to the end, it's really not that complicated. Essentially, is when the financial system needs money, meaning that the liquidity is dried out, the Federal Reserve or the central bank of the other country is going to go ahead serving as the last resort for those financial institutions. And of course, the central bank don't want to or reluctant to print money from the thin air. So if you want to get some money from the central bank, you need to put a collateral. You need to put something there to get the money. It's similar to the pawn shop. So when you go to the pawn shop, you need to put either treasury or a pretty luxury watch or something good, right? And the pawn shop will say, okay, you can keep the stuff here and I will lend you some money, usually at a pretty high interest rate. And you have a great period of time. You have to go back and pay back money and get your collateral, or you get your treasury or your things back. And in this case, the central bank is serving as the pawn shop. And whoever is needing the money, they are actually those financial institutions. They need the money. And this whole process is called the lending facility. And of course, central bank doesn't give you a high interest rate. And those money are lending as a lifeline to this financial institution. So what the Federal Reserve will take as this collateral. In 2008, the Federal Reserve has 6 different types of lending facility. For example, term securities lending facility. This type of lending facility accepts mainly the government-backed securities. When we are talking about the government-backed security, we're talking about either treasury at different maturity or the mortgage-backed securities to provide the financial institution, including the shadow banking, some liquidity. A little bit more on that. In the history, the Federal Reserve has provided this type of lending facility during the Great Depression. So from 1932 to 1936, the Federal Reserve provide 123 lending to non-bank financial institution, and altogether is about $1.5 million. It's a very small amount at the time. So in 2008, the Federal Reserve is the first time after the Great Depression providing non-bank such as AIG and Bear Stearns, those non-bank institutions, as a way to get money from the central bank as their pawn shop. And this time, the Federal Reserve is actually doing something even more innovative, never been done even in the 2008 financial crisis. So they are not only taking the government-backed securities, but also some more risky corporate debt and also municipal debt as the collateral. And more recently, they are also providing the lending facility to the international central bank, essentially providing the liquidity to the other countries' central bank. You know, when you see the people go to the pawn shop but didn't take those valuable stuff, then you know that person or that family is really lack of money. And a few days ago on the Federal Reserve website, there's an article saying that during the financial crisis, AMA works to reduce the opacity for the financial institution so that the public can increase their trust and confidence into this financial system. And now you can see this is the problem. However, if we are simply using what we have during the financial crisis in 2008, it doesn't work due to three different types of problems. The number one is 2010, we have the Dodd-Frank reform. This Dodd-Frank Act is because of the financial crisis in 2008 is rooted in the financial system. So after that, there are a lot of reflection on the Congress, and eventually they passed this, the Dodd-Frank Wall Street Reform and Consumer Protection Act, and often shorted as the Dodd-Frank Act. Before the reform, it only take 5 out of the 7 branch president of the Federal Reserve to agree upon this lending facility. And now it needs the Secretary of the Treasury has to sign off on that. And that's why in this CARES Act, it says clearly that the Department of Treasury is going to cooperate with the Federal Reserve to provide this lending facility. The second problem is in 2008, the main problem is not the general economy, even though it kind of dragged down the general economy, but the main problem happens within the financial system. However, this time, this is the whole economy. Not long ago, in the middle of February, the unemployment rate in the U.S. is as low as 3.5, the lowest since probably 1962. And now we are seeing within 2 weeks of time, there are more than 10 million people are losing their job. NBC predict that unemployment rate can go as high as 32%, even higher than the peak of 24.9% in 1929, this Great Depression. So because of the size and the magnitude of this economy freezing, it needs even bigger financial aid to help this economy. And of course, in this CARES Act, what is provided to the Department of Treasury and you can be used for this lending facility with Federal Reserve is about $454 billion. The Secretary of the Treasury, Stephen Mnuchin, when he was interviewed, he said that himself, working with the Federal Reserve, we will have up to $4 trillion of liquidity that we can use to support this economy. Now, he also say those are broad-based lending programs. We can leverage our equity working with the Federal Reserve. So you hear the keywords, $4 trillion, not $454 billion, and also the leverage. So the leverage is 1 to 10. The problem is how does $454 billion can be used as $4 trillion? And why not the Department of Treasury simply agree upon that and need this real money of 454 for this? And that is related to the third challenge for using this lending facility. And that is another term in Dodd-Frank Act. It says when the Federal Reserve providing the financial aid, it need to be secured sufficiently to protect taxpayers from losses. So those are some of the constraints that the Federal Reserve cannot easily legally go out to buy those corporate bond or the municipal bond. So how they get around it? It's a bit long today, so let's stop here. And last time, in last video, we talked about kind of the background for this big magic show. And today we talk about the two sets of this magic show. And next time, we are going to talk about how this magic show will be implemented. I'll see you next time.